There are 3 important facts you probably don't know about your financial advisor. That's according to MoneyWatch blogger Allan Roth. A financial advisor himself, Allan says your ignorance could be costing you a lot of money. Hi, Allan.
Hi, Jill.
Great to have you here. So let's just jump in. So investment advisors, stockbrokers, everybody, they're just as bad at market timing as the rest of us humans, right?
Yeah, they are really, really good at timing the market really poorly.
So what they do well is they're wrong consistently.
Consistently wrong. TD Ameritrade released some data, and what it showed that at the end of 2007, when U.S. stocks had doubled and international stocks had tripled, they felt really brave with their clients' money. And they had only 26% of the assets in conservative cash and fixed income. However, at the very bottom of the market, on March 9th of 2009, they'd nearly doubled the allocation to those conservative assets just in time to miss the fastest bull market in the U.S. history. And to date, stocks are up about 75% from that.
Wow, and they missed that whole run just because market timing really doesn't work.
They are human.
Right. Isn't that nice to know?
Fear and greed are powerful motivators.
They sure are. So let's shift a little bit to performance, because you say that there's a little shading of the truth that some advisors do when they're reporting their performance to their clients. Tell me about that.
Well, markets are nearly 90% professionally managed, and 90% can't be above average.
Okay, so they fudge the numbers a little bit, but you as the client, what should you do to fix that?
To fix that, you should get your advisor to put in writing what your performance is versus the appropriate asset class.
So if you're a balanced investor, I invest 50-50, and your advisor says, hey, when the market went down, we beat the index, the S&P 500 index, by a walloping amount, you're saying that's kind of fudging it because you shouldn't be measured against an all-stock index if you're a balanced investor, right? What should you use?
What you should use is the appropriate asset classes. Let's say the percentage of your assets that are in the total U.S. market, the percentage of assets in international, and the percentage of assets in bonds. And you can use some low-cost ETFs as benchmarks, such as the Vanguard Total Stock, Total International, and Total Bond Fund.
So when you look at your performance, you kind of get this black and white picture. You think it's set in stone. Make sure that you ask your advisor whether this is the most appropriate way to measure it, but that's going to make the advisor work a little bit. He or she's not going to be happy, is he?
Really not going to be happy when you ask them to put in writing in an email or something simple that they have beaten those appropriate benchmarks.
Right, and they've got to be careful about that from their own compliance standpoint. So they can't be saying stuff that's not true.
Well, actually, what I found is a lot of advisors say stuff that aren't true, but they won't put it in writing.
Right. So hold their feet to the fire.
Absolutely.
Okay. So, Allan, what are the 3 things that investors should get in writing from any advisor who is charging them money for financial advice?
Number 1, the total fees that they're paying on an annual basis. Very important to get in writing the total fees. Number 2, the performance of the portfolio versus the appropriate benchmark, and naming those appropriate benchmarks.
So you can test it in the future.
Absolutely.
Right.
And then finally, why the products, why the portfolio is appropriate for you.
And if your advisor balks at putting any of these things in writing, you say?
Run and run fast. If they hand you a set of disclosure statements that are 3 inches thick, what you really need to see is somewhere buried in there, and run.
Allan, you say that some advisors might have a secret motive or an incentive for putting a client in a particular product or some kind of service. Explain that a little bit.
Well, there are different models of charging. The commission model, it's not exactly a secret that advisors will sell what they make the biggest commission on. And the fee-based model, the percentage of assets model, is a better model, but there are bad incentives there as well. Think of it, if I charge you 1.25% and give you a nice, simple, diversified portfolio and do the occasional rebalance, you might ask, why are you paying me for that? So it gives the incentive to create a more complex portfolio. And now when you think of bonds, a very good bond fund like the Vanguard Total Bond Fund, it's only yielding about 2.5%. So if I put you in that, I'm taking half of your return away. And that's leading advisors to putting people in riskier, lower credit quality, longer duration bonds, the same things that got just absolutely creamed only 2 years ago.
Allan Roth, thank you so much for joining us.
Thank you, Jill.
And thanks for watching.